Most investors think this rally will never end, but history says otherwise. Every time valuations get this high, the market takes a breather. Right now, the S&P's forward PE is 24. The Buffett Indicator, well, that's near record highs. And the Schiller PE, one of the best long-term valuation gauges, it's flashing the same warning sign. That's why I'm expecting a healthy double-digit pullback. Not a crash, but a correction that's healthy. In this video, I'll show you exactly how I'm positioning, and not to panic, but to protect my gains that I've made so far. And then when that pullback hits, we'll be ready to move in and pounce. So I'll show you the live hedges and trades that I'm putting on the trading platform. Go ahead and smash that like button down below if you haven't already, and let's jump into it with the valuations, because that is really where it begins. Right now, the S&P 500's forward price-to-earnings ratio is sitting at 24. To put that in perspective, the long-term average is closer to 16 or 17. So that's a big gap. And every time we've been this high, in 1999 and in 2021, the market eventually cools off. Now, that doesn't mean an immediate crash, but it does mean returns tend to flatten or pull back until earnings catches up to prices. Now, that doesn't mean an immediate crash, but it does mean that prices tend to flatten and pull back until the earnings catch up to the prices. Let's take a look at the Buffett Indicator. Warren Buffett himself has said that this is one of the best long-term valuation tools. It compares the total value of all U.S. stocks to the size of the economy. And right now, it's near all-time highs, basically saying the market's worth way more than the economy can justify. And then there's the Schiller PE or CAPE ratio. This one smooths out earnings over a decade to remove short-term noise. It's sitting in the same territory we saw right before some major corrections. Again, not a doomsday signal, but a reality check. So between these three, the forward PE, the Buffett Indicator, and the Schiller PE, markets are definitely priced for perfection. And when they're priced for perfection, they just need any reason to fail. It doesn't need a big event. Any reason will work. It could be inflation creeping back up, slower growth, a softer earnings season, the government shutdown. History shows that once valuations are stretched this far, the market always finds a reason to correct. But here's the thing. Corrections aren't bad. They're opportunities to make a lot of money. Healthy corrections are normal in strong bull markets. If you take a look back over the last few decades, bull markets have always taken breathers. A 10 to 15% drop sounds scary in the moment, but it's really just the market resetting, shaking out the excess and making room for the next leg higher. Think of it like this. When prices run too far too fast, sentiment gets extreme. Everyone's bullish, everyone's leveraged, and that's exactly when the market takes a step back. It flushes out the euphoria so the long-term trend can stay intact. Right now, the data supports that. Sentiment's been greedy and at greedy levels for weeks. Even small dips are getting bought instantly. That's not sustainable forever. So I actually welcome a pullback, because when everyone else sees red, that's when the best setups are starting to form. Lower prices mean better entry points, especially if you've kept some cash or dry powder on the side. So here's what I'm doing right now to protect my gains. Step one, I've been raising a bit of cash, not selling everything, but trimming positions that ran too far too fast. Having cash on the sidelines gives me more options, and in volatile markets, options are power. When that pullback does come, I've got dry powder ready to deploy into great companies at a discount. Step two, I am adding some hedges. That could mean buying some protective puts or using inverse ETFs. Now, step three, I'm rotating a bit more defensively. That means more exposure to sectors like healthcare, staples, and I'm DCAing or dollar cost averaging into my long-term companies that are going to be profitable. They're profitable right now. So companies like Meta, Amazon, and Google, areas that hold up better when the market cools off, and they're going to continue to do well for the next 5 and 10 years and beyond. Now, the best opportunities don't come when the market's at all-time highs. So let's jump into the live trades and I'll show you how I'm hedging right now. All right, guys, there's three main hedges that I'm using right now. And this is the Tasty Trade trading platform. There's a link down below. Check it out. It's my favorite for trading options and using hedges like I'm going to show you right here. The first one, the Qs. So we know the Qs, the NASDAQ, how it's been trending up. We've got the green, the 50-day moving average, and the 200. And we just had a big pullback on Friday, but there's a good chance this is going to keep coming down back towards that 200-day moving average. Definitely, I mean, if it breaks the 50-day, we're look for further drop. But here's what I'm doing. I'll go to the trade page here, and I'm going to go out 69 days to expiration on this. Once we get inside 30 days, the time value really accelerates. And because I'm using it as a hedge, I'm buying a put option. So we're going to open up that December, and then I will buy a hedge. I'm going to buy right here that, let's see, this is a little bit in the money, the 590 put. We're trading at 589 right now. So I'm going to click here. Puts are on the right, calls are on the left. I'm going to buy it for 2101. So one option contract controls 100 shares of stock. So that's really $21 times 100 shares, or $2,100. You can see the buying power right here. That is also the max loss. And we're not going to hold this thing 69 days. So we're not going to lose that entire $2,101. But check this out. If we go to curve mode and now analysis, you can see as the market goes down, we make money. It goes green, profitable. So if we have a 10% drop, that would go from 590, so 600 down 60 points to 540, somewhere in there. We make quite a bit of money back. P&L at expiration at 540 is almost $3,000. So it's a great hedge, and the way that we can profit as the market pulls back. So here I would just hit review and send and place the trade. I've already got it on set up below the market, and I'll adjust on Monday. The next one, SPY, same situation. If we look at SPY and the chart, just similar to the Qs, same situation. So looking for a pullback, same trade. I'm going to go on SPY. It looks like I'm going out 69 days as well. Or no, I'm going, I've already got 69 on and a 41 days that on. So I've already got two positions on short SPY puts. I'm going to add another at 97 days. So I'll even a little bit further. So let me, in the 655, I'm going to cancel that and show you exactly how I place it. Go to SPY, table mode. We're going to go out 97 days. So you can either go, 70, 90, but this gives you a pretty good price. And then we can go out to the 655 or 690, and puts are on the right. We're going to buy. We can buy that. And then if you go to that curve mode, you can see how that hedges. So we can go back to here. I'm going to put it below the market, $20, and good till cancel. Change my day to good till cancel, and I'll just keep that on. And I'll have that Monday on, and I'll readjust when the market opens. All right, the last one I'm going to show you, similar situation, but this time it's TSLZ. So if we look at Tesla right here, look at the chart. It's way up near the top up here, a lot of resistance, and it had a pullback. When Tesla is this overvalued, let's look at the 10-year, look at 5-year chart, and then we'll go to monthly. Let's go 10-year. Does it go to 10-year? Let's see. Yeah, 10-year. Look where it is. It's way up near the top. So I like Tesla long term, but look at that trend up. And look where we are on the Bollinger Band, way up here near the top. So it's at 413 right now. A lot of people have, it's not, the numbers are horrible right now as well. It's up there. Everybody's, banking on the humanoid, and the battery power, the EV sales. They've got a lot of different ways of making revenue, but they're not here yet. So that's going to be a few years out. I think long term it's going to be great, but when we're up near the top of the trend right here, that's when I want to short it. And 413 to me is overpriced right now. So, and it's going to be extremely volatile. And since it's at a high, it's going to drop. If the whole market drops 15 or 20% or 10% even, Tesla could be cut in half and drop 50%. So that's why you get a lot of bang for your buck by, in a way, shorting it. But the way that I'm going to short it is by buying TSLZ. So TSLZ is a inverse Tesla ETF. So it basically is a 2 times when Tesla moves down, this thing doubles and makes profits. So if you look at the chart for TSLZ, I don't know how long it's been available, but let's go to the daily and year to date. But you can see it's moved down as Tesla's moved up. So this could easily spike. Let's go a year. And you can see where it was. It was at 15 up here, 14.8. And it's under 1 right now. It's at 0.8. So way down here. But this can really scream and make a lot of money as it moves up. So what am I doing? I've got 2,500 shares right now. I'm going to buy 3,000 on Monday, and I put it below the market. So let me take that off, and I'll show you exactly how to do it. But we go to the trade page, table mode. Actually, there's no options available on TSLZ, so I'm just going to buy the stock long. So stock long, go. You can do this on any platform, but right now the mid price is 0.69. I'm going to put it below the market. So I'm going to put it at what, 0.5? And then number of shares. I was going to do 3,000. So, you know, I'll start with 3,000 on Monday. And what's the cost? $1,500, but the real price at 0.7 is going to be a couple thousand, 3,000, but whatever the size of your account, you can figure appropriately. But I'm just going to go ahead and hit review and send. Well, I want good till canceled. Good till canceled, review and send. All right. I've got that set up for Monday's open, and I'll readjust it and go TSLZ long. Once that pullback hits, whether it's 10, 15, 20%, really doesn't matter. Here's how I'm going to be ready. First, I've already built my watch list of quality names that I want to own more of. Great balance sheets, real earnings, strong long-term trends. When those drop back to fair value, that's when I'll scale back in. I'm not trying to nail the exact bottom. I'm buying in stages. I'll also be watching for signals. So if the VIX spikes, sentiment turns super fearful, and that fear and greed index goes way up, insiders quietly start buying. Those are all signs, classic signs of panic and opportunity. And here's the best part. By staying hedged and liquid during the drop, I'm going to have that cash to deploy and really jump in and make profits when the market turns. So while most investors are reacting and panicking, I'm preparing. I'm not trying to predict when that 10, 15, 20% drop will come. I just know at some point it will. Let me know in the comments below what you're doing to protect and hedge should there be a pullback of 10 to 20% in the coming months. Make sure to like, subscribe down below. Check out the free options workshop. There's a paid course as well if you want to level up your game. And leave a comment. Let me know what you're doing. All right. If you like this video, watch this next one.